it's going to be that way. Okay.
Is the ending inventory usually between the other two?
Yes, it will need to be, yes. So now,
Yeah. Average.
the management of Rosenquist Corp. is considering the effects of various inventory costing methods on its financial statement and its income tax expense. Assuming that the price the company pays for inventory is increasing, which method will provide the highest net income? The highest net income, if prices are increasing, means if you start here at $6 of goods, and then you go to 8, and then you go to 10, and if we're dealing with FIFO, we're going to be using, and cost of goods sold, the lower prices. So that's going to be a higher net income. Whereas if we're dealing with LIFO, and we're going to use these figures as cost of goods sold, higher cost of goods sold, lower net income. Does that make sense to you guys? Because it's like a cost of goods sold is an expense. So it's going to end up being lower net income. Okay. Okay, let's see. Let's go back to the PowerPoint now and start talking about some more items here. Now, one aspect that is required by generally accepted accounting principles is that once you start with a certain costing method, you have to continue with it. You can't one year decide I'm using LIFO, the next year you're using FIFO. You can't do that because it's going to screw up consistency purposes, okay? So once a method starts, it needs to be continued. If you want to compare your one year to the next, it screws it all up because one year your cost of goods sold is going to be, or your gross profit will be a certain percent, where another year it's going to be very different. So you can't really compare the years. So usually if a company does change methods, they need to disclose it and explain why they did that.
So it's not like you never can, it's just...
It's discouraged, but like in this example.
You have to put some notes in the
You do.
report. And
Effective July 1st, the company adopted the LIFO cost flow assumption for valuing the majority of U.S. grocery products inventory. The company believes that the use of the LIFO method better matches current costs with the revenues. The effect of this change on the current year was to decrease net income by $16 million. So again, LIFO is going to result in a lower income tax or lower net income. Now there's another type of costing method called lower of cost or market. What happens here is when inventory is purchased and then for reasons of time, technology advancements, the value of the inventory is not worth what we bought it for. Then we need to write down the difference between what we purchased it for and its market value today. So basically, if we look at purchasing an item for $100, but today we could purchase it for $50, we need to show our inventory or that loss. We need to write that down to reflect truly what our inventory is worth. So the way we're going to do this is an example. Kentucky has the TV has the following lines of merchandise with costs and market values as indicated. We've got flat panel TVs that we paid $60,000 for, but are currently on the market, or we could buy them for $55,000. We'll need to adjust our inventory to show that $55,000. Next, we have satellite radios that we purchased for $45, but the market shows $52. We'll always take the lower of cost or market. We're going to be conservative, so we'll use our cost. Next, we have a DVD recorder. It costs $48, but today we value it at $45. We're going to take the $45. We have DVDs that cost $15, but the market is $14. We take the market of $14.
Is this a system people choose, or is this
You
just-
have to.
Oh, okay.
You're
So this is one of the choices to that, was that in the other category that you had on that pie chart?
No.
Because there's
The
like LIFO, FIFO.
average cost
then
and
there's like-
specific identification.
Okay.
but-
Is this a fifth one?
No, this is required.
Oh.
For an example, you can do FIFO, you can do LIFO. But if your inventory is overvalued because it's been sitting there, or due to technological changes, or maybe a fire in the warehouse,
Okay. So all those other methods are those, and then this
This-
everybody could have
everyone
the potential
has
to use.
to do this.
Okay.
So if, let's
If
say.
it's applicable to their business.
Correct,
Okay.
correct. So let's just say that Best Buy goes out and purchases 60-inch flat-screen TVs for $2,000 apiece, okay? And they have 100 of these in their warehouse. But Apple came out with an 80-inch TV that does everything you want, and it's at $2,100 apiece. So if the demand for one type of TV is greater, and so as a result of the competition, Sony, instead of selling them to Best Buy for $2,000 apiece, goes and says, okay, I'm selling them to you for $1,600 apiece now. That TV they bought for $2,000 is no longer on the market with their cost of $2,000. They can now buy it for $1,600. Therefore, they need to write down the inventory, because you take either the lower of what you bought it for or the lower of what you could buy it for on the market.
So is that carried at like an expense, like write-down expense?
Correct.
Or something?
There's going to be an adjustment to, like an impairment.
Inventory
Yeah,
adjustment.
inventory impairment. So just know that when we purchase an item, let's say a jewelry store holds an item, they purchase a diamond ring for $10,000. That's their cost. Let's say today that diamond ring's market value is with $40. Doesn't matter. You still show it at the lower of cost or market. Where this affects you is when market goes below your home, or your whatever inventory. For example, let's talk about it. So let's just say we're sitting on a home. A builder has a home to sell. He shows all the costs he put in that home. And he might have the cost of that home sitting with everything he's put into it, all the subcontractors, everything, of $200,000. That is his cost of that home and inventory. Okay? But if he can't sell that home for $200 or $210 or $220, homes just like his are being purchased now, or are being built for $170. He has $200 in his home, but the value's gone down. Okay? So he'll have to mark down his inventory based on what the new market costs are for the home. Think about what happened in our economy over the past several years with homes. The homes weren't worth anything near what people paid for them. Lower of cost or market, if it's a business, they would have to adjust that asset on their books. Make sense? Now, we're dealing with inventory here, turning around and selling something, but even as far as...
Like the cars we were talking about earlier, if the 2014s and the 15s come out and they go down in price $5,000, and they've got to
adjust that, correct. So in the case of lower of cost or market, you're required to take the lower of what you paid for it or the lower of what you could buy it for.
So this is strictly for your inventory though, so, I mean.
Correct, right now inventory.
Yeah, so I mean, even though it might be market low below what we paid it, we might sell it for more than what the market is maybe at later on. But
But
for inventory.
for
reasons,
inventory,
we
you
have
need to
it the
do
lower
this.
than- Yeah.
So inventory management is a really a challenging job to really weigh out the balance you need. You definitely need to have items to sell, like this leisure travel. They don't have enough to sell. I mean, fortunately, I got one somewhere else, but if the wait time's 9 months, I'm not gonna wait 9 months. I would have bought something else, okay? That's a negative when there's not the ability to purchase something, you get lost sales. That's a negative. But what's worse, high inventory levels are really tough too. Because you've got huge storage costs, warehouses that cost money, people demand them, security. You've got the interest you've got to pay on having this inventory on hand. You've got, with high inventory, the ability or the result of potentially having obsolete items gets greater because there's more to get rid of. So really, inventory management is a fine line between making sure you have enough, but then an excess of inventory is a critical aspect of not being able to sell the items. We're going to talk about some ratios. Inventory turnover ratio really helps a user see the effectiveness of management in turning over their inventory every so often. So when inventory turnover is relatively high, that means management is being efficient with only producing as much as they need in order to sell the goods and keep it flowing. Days in inventory is basically taking our ratio, taking our 365 days a year and dividing it by our ratio, which basically lets us know how many days do items sit in inventory before they're totally turned over. Dell Computer, as of a couple of years ago when I looked, their days in inventory was 7. They turned their inventory over that speedily. That's pretty amazing. So it's almost like a just-in-time, you know, when they need it, they produce it and they get rid of it. So inventory turnover ratio, we're going to look at an example here. We're going to look at the ending inventory, and the way we calculate the average ending inventory, you see how it says average inventory here? We're going to take the inventory at the beginning of the year, the inventory at the end of the year, and divide it by 2. We're going to come up with an average. So we're going to take our cost of goods sold, which is here $315,287. We're going to divide it by our average inventory, the $36,318 plus the $32,713 divided by 2. And we show our inventory turnover is 9.1 times in a year. So we have 12 years in a month, probably, 34, 5 days, 40 days, so I was off. So basically, it turns 9.1 times in a year. Now, if you look at the days in inventory, we take that 365, divide it by 9.1 to see exactly how many days it's sitting in inventory. So as you can see, in 2010, our inventory turned over 9.1 times. In 2011, boy, they weren't really efficient. It turned over 6.2 times. And then back, if you look at the industry average for 2011, excuse me, this is
Yeah.
Target,
Yeah,
not
it's
Walmart.
Target.
So,
So 2011 was my
so
approach.
in 2010, Walmart, because yeah, that would surprise